Next, we go to the cost of sales, COGS for short. It is the cost of acquiring or manufacturing the products that a company sells during a period. So the only costs included are those that are directly tied to the production of the products, including labor, materials, manufacturing overhead. By manufacturing overhead, I mean everything that is not labor and materials, like security, lighting, and telephone expenses. Now let's look at Apple's products and services. Cost of sales is $212 billion, composed of two categories, products and services. Obviously, products is much more because they sell much more products such as the iPhone as compared to services. The next item on the income statement is the gross profit, which is the profit of a company makes after deducting the costs associated with manufacturing and selling its products and services. It can be calculated by subtracting the cost of goods sold from revenues. Probably it is the most important number in the income statement. How much are we selling for minus what is its costs of a particular product? The gross margin is $152.8 billion, and it is 41.78% in percentage form. In other words, from every $1 of sales of Apple, they make 41.78 cents. This number is unbelievably high, probably among the highest among manufacturers. As said before, Apple is a much beloved company and they have the ability to charge high premiums. Next, we have operating expenses, which are expenses a business incurs through its normal business operations. These include rent, equipment, inventory, marketing, payroll, insurance, and funds for R&D and marketing. As an example, if you look at Apple, their total operating expenses are $43.8 billion, the main big component of it being research and development, which is almost $22 billion. In percentage form, total operating expenses are 12%. Now let us see the next line item. Operating income measures the amount of profit realized from a business's operations after deducting operating expenses. Analyzing operating income is useful because it doesn't include one-off items that may skew a company's profit in a given year. This is essentially a measure of a firm's core income. Remember, so far we saw the gross margin and operating expenses. If you want to compare the gross margin from the slide earlier, which was almost 42%, Apple makes 42 cents on the dollar from sales. Deduct a further 12% in operating expenses to arrive at 29.78% from operations. The next line item is other income. Gains and losses are produced through a company's non-primary operations. You sell a store, a warehouse, the corporate jet, the office computer which you no longer use, that would be other income, since it is not inventory. Only inventory gets classified under revenues. Anytime a company produces a profit or realizes increased value through secondary sources, it is a capital gain. Conversely, a loss is realized whenever a company loses money through secondary activity. For Apple, this is a tiny amount of 0.07%. They had $258 million of other income this year. The next line item is EBIT, which is what we make before we pay the bankers and the tax person. This is the best measure of what shareholders make from the business before payouts to bankers and taxes. Next is interest expense, which is the cost incurred by an entity for borrowing from bankers. Obviously, borrowing money is not for free, and the amount incurred is an expense. Conversely, if you have a lot of unused cash, you can lend it out, and the interest you charge will lead to interest income for you. Next is income before taxes, which is the business's net income after all operating expenses, but not taxes have been factored in. This is a useful metric for comparing business performance because it removes the variability of taxes which change over time and across jurisdictions. As you see, Apple's income before the provision for taxes is $109 billion. If you were wondering what provision means, it means to set aside. Just like people a few thousand years ago kept potatoes as provisions for the upcoming winter, companies of today set aside a provision to what they will have to pay to the government. Next is the tax expenses, which are the total amount of taxes owed by the corporation to the taxing authorities. In the case of Apple, this includes income taxes at the city, state, and the federal US level, and also taxes owed abroad in all the countries where they generate income. Taxes are normally at the source, and the source is determined by country. Income tax expense is arrived by multiplying the taxable income by the effective tax rate. For the case of Apple, their tax expense is $14.5 billion a year. This is about 4% of their total sales and about 14% of their pre-tax income. Given that the US tax rate is at 19%, this 5% differential is likely explained by a variety of tax deductions and incentives they have received both from the US government and other governments where they operate. Now we arrive to the Holy Grail, the most important number in accounting, the bottom line, net income. Also called net earnings, is the summary performance measure of a firm. It is a useful number for investors to assess by how much revenue exceeds the expenses of an organization. This is probably the most important indicator of a company's success. For Apple, that number is a staggering $94.6 billion. Steve Jobs, God bless his soul, would be smiling, wherever he is watching us from at the very moment. From assembling parts and selling circuit boards in 1971 to $94.6 billion net a year. Not bad, everyone would agree. So let us set up everything together here. Sales are split between products and services and amount to $365 billion. The gross margin is 41.78% of that. The rest of the operating expenses take out another 12%, and you are roughly left with 29.8% of operating income. Taxes take out another 3.97%, and the bottom line, the net income, is a cool 25.88%. Here you go. This is the summary of Apple's performance in a nutshell. One of the wonders of accounting, you look at an income statement, and it clearly shows you, step by step, how much value we created and line-by-line costs of running the business.